As the U.S. markets are currently closed, Nuburu Inc., trading under the ticker BURU, closed the last trading session on Friday, October 10, 2025, at $0.21 per share, down 4.55% for the day. And that price, that single figure, tells a story of profound dissonance. This isn't just a stock having a bad day. It's the market's brutal assessment of a company caught between a fantastic technological promise and a harrowing financial reality. The expectation, the narrative that likely drew early investors in, is that of a pioneering technology firm wielding a unique blue laser system poised to change advanced manufacturing. The story is about enabling the electric vehicle boom, revolutionizing battery production, and powering next-generation electronics. But the reality, reflected in that sub-dollar stock price and the relentless selling pressure, is that Nuburu is a company fighting for its very survival. The market isn't pricing in its future potential, it's pricing in its current cash burn, its desperate need for capital, and the very real possibility of failure. This gap between the brilliance of the lab and the cold, hard math of the balance sheet is where the entire investment thesis for BURU lives and dies. Most retail investors, perhaps doing some self-investing on platforms like the Robinhood app or a SoFi Invest account, are attracted to stories like Nuburu's. The concept is easy to grasp and incredibly appealing. The company designs and manufactures high-power industrial blue lasers. This isn't just a different color, it's a fundamental advantage. Traditional infrared lasers, the industry standard, are poorly absorbed by highly reflective metals like copper and gold. Much of their energy literally bounces off, leading to inefficient and often messy welds with a lot of spatter. Nuburu's blue lasers, however, are absorbed by copper up to 20 times more effectively. This creates a faster, cleaner, and stronger weld. The application for this is immense, especially in welding the copper foils and connectors inside electric vehicle battery packs, a critical and rapidly growing industry. The expectation is that as the world transitions to EVs, anyone who needs to weld copper at scale will have to turn to Nuburu. It sounds like a surefire bet, almost like getting in on the ground floor of a company supplying critical components to giants in the way some view suppliers for Tesla stock or Apple stock. But the market, particularly the more sophisticated capital managed through Fidelity Wealth Management or traded on platforms like Interactive Brokers, is telling a different story. The daily price chart for BURU doesn't look like a high-growth tech stock. It looks like a company in distress. The stock has been subject to immense volatility, sharp declines, and, critically, a reverse stock split in its past, a move companies often make not from a position of strength, but to regain compliance with exchange listing requirements and avoid being delisted. The trading volume is often thin, meaning small buy or sell orders can create disproportionately large price swings. This isn't the orderly price discovery you see with a blue-chip stock. It's the chaotic signature of a highly speculative microcap security, dominated by retail sentiment and the ever-present threat of dilution. Every press release from the company is scrutinized not just for new contracts or technological advancements, but for any mention of financing. The market's primary question isn't how much can you grow, but how much cash do you have left and how will you get more? This is the harsh reality that clashes with the exciting technology narrative. The company is in a race against time, and the stock price reflects a deep skepticism about whether it will win. To truly understand the predicament, we have to look at what the company does and its financial state. Nuburu's core business revolves around selling its blue laser systems, the hardware, to industrial clients in sectors like e-mobility, consumer electronics, and defense. They offer both the standalone laser light engines and more integrated systems for specific applications like welding and 3D printing. The technology itself is protected by a portfolio of patents, creating what should be a protective moat. They went public via a SPAC merger, a common route for early-stage companies to access public markets, but one that has often led to poor long-term performance for shareholders. The initial excitement quickly gave way to the difficult reality of being a publicly traded company with significant cash needs. When you open their quarterly and annual reports, the conflict between expectation and reality becomes crystal clear. On one hand, you might see revenue growth, which management will highlight as proof that their strategy is working and that there is real demand for their product. But right below that top-line figure, you see the costs. Research and development costs are high, as they must continue to innovate. Sales, general, and administrative expenses are also substantial for a company of its size. The result has been consistent and significant net losses. The most critical metric to watch for a company like Nuburu is its cash burn, the rate at which it is spending its available cash reserves. By looking at the cash on the balance sheet and the cash flow from operations on the cash flow statement, one can calculate a rough runway, how many months the company can continue to operate before needing additional financing. For much of its recent history, this runway has been uncomfortably short. This financial pressure forces management to raise capital, often through secondary stock offerings or the issuance of warrants, which adds more shares to the market and dilutes the ownership stake of existing shareholders, putting further downward pressure on the stock price. It's a vicious cycle that is incredibly difficult to break. This is the kind of fundamental analysis that is essential for any serious online investing, something that a service like Schwab Intelligent Portfolios would likely screen out due to its high-risk profile. Looking ahead, the future for Nuburu is a binary outcome, with very few possibilities in between. The bull case, the scenario where investors could see a monumental return, depends on a series of difficult but achievable milestones. First and foremost, they must secure a major company-making contract with a large-scale manufacturer, perhaps a Tier 1 automotive supplier or a major EV maker. A multi-year, multi-million-dollar order would not only provide a massive revenue boost, but more importantly, would serve as a powerful validation of their technology, making it easier to attract other customers and secure favorable financing. Second, they must achieve operational efficiencies that dramatically reduce their cash burn and move them toward profitability. This means scaling production, lowering manufacturing costs, and controlling operating expenses. If they can achieve these two things, they could transition from a story of survival to a story of growth. The market would be forced to re-rate the stock, moving its valuation away from a distressed asset toward a genuine growth tech company like a young Nvidia stock. But the bear case is arguably more straightforward and represents the current market sentiment. The primary risk is liquidity. The company could simply run out of cash before it can achieve the scale needed to become self-sustaining. Any downturn in the broader economy could cause potential customers to delay capital expenditures on new manufacturing equipment, directly impacting Nuburu's sales pipeline. Competition is also a lurking threat. While Nuburu has a head start in blue laser technology, larger, better capitalized laser companies like IPG Photonics or Coherent could eventually develop competing solutions, squeezing Nuburu's margins and market share. Finally, the risk of further dilution remains ever present. Future capital raises are a near certainty, and the terms of those deals are unlikely to be favorable to to existing common shareholders? Do you think Nuburu can land a transformative deal with a major EV manufacturer before it runs out of options? Comment your thoughts below. For anyone considering an investment here, it is crucial to understand that this is not a widows and orphan stock to be tucked away in a Fidelity IRA. It is a high-risk, speculative venture. In conclusion, the story of Nuburu is a classic tale of technological brilliance meeting financial gravity. The expectation is an elegant solution to a critical manufacturing problem in the world's fastest-growing industries. The reality is a micro-cap company teetering on a financial precipice where every quarter is a battle for survival. The potential for the technology to be widely adopted is real, but the potential for the company to fail before that happens is as real, if not more so. An investment in BURU today is not really a bet on blue lasers. It is a bet on management's ability to navigate an incredibly difficult financial situation. It's a bet that they can secure the funding, land the contracts, and scale the business before the clock runs out. The promise is enormous, but the risks are equally stark, and the market's current valuation makes its skepticism abundantly clear.